that, the money in there is I've got $250,000 in two separate redemptions, 200 and then 50, and then I'm also the remainder of that is about 250,000 that that is construction holdback, not construction holdback, but yeah, it's holdback on improvements for the Sonoma deal that I did. That was yeah. So I've got 500. So I've got like a 1.2 million in there now. I'm doing a $700,000 loan. I've got about $500,000. That's half is redemption, the other half is holdback.
Okay, so there's no more liquidity for the most part.
No, but I've got two different people are threatening to send $250,000 or $200,000.
I love that. Oh, they're threatening to do that.
Yeah, so I'm waiting
for send us money.
So I'm waiting on $200,000. I just deposited 50 new today, so I wasn't counting that either. But yes, it's actually pretty good. I have to go back and check and see who's. I should be getting some more payoffs soon. I did got two payoffs in the last 30 days, about 500 worth. Hello.
Yeah.
So that.
I got 3 payoffs last month also.
You did. Wow.
From you guys. Well,
Yeah.
how's your thing going with Jeremy?
He said about 20 days.
Okay.
And then I looked up my. I wanted to take a peek at my scores because the last time I looked, which was right before he pulled credit, I want to say about 6 weeks ago, because I have an account with Fair Isaac on myfico.com, which gives you your true scores. In fact, they give you multiple scores because there's different FICO flavors of FICO. Car bureaus or auto, when you buy an auto, they pull a certain type of FICO. When you get a mortgage, there's a mortgage FICO, and it's usually less than what your true FICO
you should
is.
mention that just as an education thing.
Yeah, it is. That's a great thing to talk about. And I can talk about this because I went on to check. I went to myfico.com to check my scores, and they had all. I had 2 of my 3 were above 800 previously. Now they're in the high 7s, but I noticed one had dropped, and that gives me all the indications as to why they dropped.
Yeah.
One of them said it was a 22-point drop because I got a new credit account. I said, wait a minute, I've got no new credit in months. And according to Experian, I got a new credit card for $2,000 with U.S. Bank in March, and I did not do that. So
yeah, but
I have
even
to
if you did
investigate that.
$2,000, why would they drop it that many points?
22 points in credit. That is a lot. So yeah, so here I'm. So I can share a banking experience too.
Yeah.
It's actually pretty interesting.
Wow.
So
Okay, so you're still roughly 20 days away from.
basically 3 weeks if all goes well. And then I left a message. I said I was driving down here. I'm calling Jeremy on the cell, and of course he never picks up.
Yeah.
And I left him a message and said, hey, my scores just dropped. They're all still in the high 7s, but one showed new credit. I did not get that.
Yeah.
Should I dispute it or not dispute it? Because if I dispute it, it could also put a flag in my credit account, which might derail my refinance.
Oh, really? Okay.
So I don't want to do any. I don't want to make any move without his blessing. He may say do nothing because your scores are still fine.
Gotcha.
Yeah.
No, that's fine. All right. Well, I'm gonna just get ready to this, and I'll just let you. I'll turn over.
We got some goodies.
Okay. Yeah. Here we go. Welcome, you're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located about 1 hour northeast of San Francisco. Those vacations are free. Their only request, a $100 cleaning fee to cover the housekeeping expenses. Today's trivia theme is just general trivia.
Maybe I'll get one.
Maybe you'll get one. Actually, I think you will.
Yeah.
All right. Mark, what do you want to talk about today?
Well, I brought a potpourri of articles, small articles, real estate related. Since my company is Pacific Private Money, I make real estate loans, and you're formerly of the real estate investing and lending community. So
Yes.
we'll talk mostly real estate today, and some interesting stuff. I mean, there's a lot going on, but then there's not a lot going on.
Okay.
It's really strange. I mean, we're heading into spring. This is the selling season. We shared last week how when the Case-Shiller home price index came out, it's a lagging indicator by almost 90 days. Their last report was covered the month of February, And no, I'm sorry, January. And in January, prices had still been year over year in double-digit increasing. And so then we talked about, and I'll go a little bit into detail about that again. We covered about how there's some indications looming that maybe the tech industry might be slowing down, and how might that be maybe a leading indicator as to what we might expect in terms of real estate residential valuations in the coming year.
Well, yeah, when we had Patty on, we discussed the fact that things appear to be slowing down a little bit.
They sure, so anecdotally things are slowing down, but the numbers that keep coming out from these indexes like CoreLogic and Case-Shiller that have been tracking both nationwide and of course in California and within just the Bay Area, the San Francisco Bay Area, all indications are that we're still trending, that our appreciation is still trending at double-digit rates, right around 10%. And so we're all kind of waiting and wondering, okay, when's that slowdown going to come? Well, so we've got some interesting things happening in the real estate industry. We've got an article here: lower-priced homes are still struggling with negative equity. Now, remember a few months back we talked about the fact that a lot of the statistics we throw out in real estate have to be kind of a blended or average rate and the information. Like, for example, national housing prices are almost meaningless. I mean, nationwide houses are up 5%, but that's really meaningless. In the Bay Area, they're up 10%. And what does that really mean? Because there's
pockets.
There's pockets of markets. I mean, real estate's really, really local. I mean, it's neighborhood by neighborhood. And what's interesting is that, if you recall, we once talked about this graph, how in the Bay Area by itself, if you look at three segments of housing, houses that are up to $500,000 in value, then houses from $500,000 to $1 million, then houses over $1 million. And what's interesting is that the segment of the housing market that has clearly gone beyond the last high in 2007 are those homes above $1 million. They are in, again, this is average blended rate, but on average, homes above $1 million have appreciated, are about 20% higher than where they were in 2007, than the previous high.
Wow.
Homes between 500,000 and $1 million are about at the same peak. They pretty much
hit the 2007
previous high. However, now houses under 500,000, of course, there's not a whole lot of those in the Bay Area, but those are like when you go to the outskirts of the Bay Area, when you start to head into East Contra Costa County and further north, and into Sacramento.
Does this include condos?
You know what? I don't recall.
Okay.
So single-family homes, I believe, it may include condos, but again, I'm not sure. Homes below $500,000 are still, on average, 15 to 20% below their previous high. So this little blurb is a nationwide comment here. It says, while a number of underwater borrowers has been in decline for the last few years, negative equity is still an issue among lower-priced homes.
That's almost like back to the rich get richer and the poor get poorer.
That's true. No, absolutely. And it says that there were still, in the U.S., 3.2 million homes that were underwater at the end of 2015. Now, that represents less than 10% of all mortgages. In fact, it says 6.5% of all mortgages. So clearly that number is in decline.
Yeah, but it seems like, if you kind of, conspiracy theory type of thing, it's like all those people who could not even qualify for a mortgage in those lower end, they end up buying much more of a house than they could have afforded.
Well, and right, and we saw that happen quite a bit. So it says here more than half of underwater homes are in the bottom 20% of home prices. So what does that tell you? So, and I remember this, again, this is anecdotally, but as a lender, I was lending in 2007, and I remembered that as the market tanked, the neighborhoods in the areas of the Bay Area that went down the most were the ones that were in the lower priced, because they actually went up higher. I mean, there were pockets of East Contra Costa County and Sacramento and other outlying areas that I remember they doubled in price, and then they fell like 60 to 70% of what they were appraising for. So they went up very, very quickly and then went down very, very quickly, as opposed to the $1 million homes, which also went up, but they didn't go up quite as much as a percentage, and didn't drop as much as a percentage.
So I'm wondering why, with the houses that are over $1 million that have gone up percentage-wise so much, why haven't we seen like another bubble or something? What's on that going on in the lower end right now?
Well, the lower end, it's clearly, I think it's because there isn't quite the ability for people to buy those homes. I think it's hard. The qualification is so much harder today. So
that's a good point.
You know, and there's just not that much inventory. So you've got this double whammy here. Other issue or other news that I thought is interesting: banks are steadily shrinking their mortgage portfolios. So I saw this as a graph. I didn't bring the graph with me because the audience couldn't see it anyway. But if you look at a graph of the last couple of years, big banks have been steadily backing away from mortgages.
Well,
they're making their money elsewhere.
Are they selling their portfolio?
Well, this says that they're actually making fewer loans.
Okay.
And as a result, their mortgage portfolios are shrinking. And on top of that, in a separate article, I saw 2,200 mortgage jobs lost in February. And this is from the non-bank lenders. Non-bank mortgage lenders pink slipped 2,200 full-time employees in February. Now, again, nationwide. But I find this interesting because you've got, and I've heard this before about banks, that fewer banks, or I should say the banks, are making fewer mortgages than they did. Okay? So you've got the mortgage, then you've got the non-bank mortgage industry, your independent mortgagees. A lot of them have gone out of business. There's been a lot of consolidation. So a lot of what Dodd-Frank and the Financial Protection Bureau were supposed to do, which is make things better for borrowers, eliminate predatory lending practices, and presumably make it better and a more healthier mortgage market. What we're actually seeing is banks are making fewer mortgages, and there's fewer independent mortgage brokers out there. So I don't know that that's a good thing for the business. I mean, if you have fewer places where you can go for a mortgage, then how is that possibly a good thing?
It's only good for you. Your business, which we will get into in the next segment.
Yep.
As to why it is good for Pacific Private Money. Okay, we're going to cut to our first commercial break. Before we do, we've got a quick little mention here for the Capitola Hotel, which features free Wi-Fi, luxurious towels and linens, mini fridge, ceiling fans, and organic bath products. Each morning, the lobby is beautifully set with continental breakfast, and afternoon boasts an elegant display of cookies, tea, and coffee. I love that. Quaint courtyard, tranquil fountains, fireplaces, everything. Give them a call at 877-705-7377, and they got a little special here. If you mention that you heard about it on The Best of Investing with Edward Brown, they will give you a 10% discount. So that's the Capitola Hotel in Capitola, which is an awesome area. www.capitolahotel.com. All right, first trivia question, general trivia. In 1936, Hialeah in Florida was the world's first horse race track to make use of what new invention? All right, so basically in 1936 there was a horse track race, and there was a new invention that came out. They were the first race track to use it. All right, call 888-912-1190 to answer that question. And if you're the first one, you'll win that free vacation at the Lighthouse Resort. Don't touch that dial. The Best in Investing will be right back.
I have a guess.
If you don't know it after you hear it, you go, oh, that would make sense.
Okay. Yeah. You keep forgetting that your hand hurts. You go like, oh, you try to move it.
Yeah. It's like, because I had to sign some checks today, and I'm thinking, I hope that they actually clear the checks, because they don't look the same signature. I knew a left-handed couldn't work. Oops. I really like your new office.
Oh, thanks.
Yeah, it's a fun place to go. Sophia seems really nice.
Yeah, she was out sick. She had something happen yesterday. She was looking green.
It's again, people get sick again.
Yeah, well, change of weather, spring, wind, all that stuff around. So the next one, I'll just let's talk about my story about my refinance story.
Okay.
And then
That's good.
from that we'll dovetail into how much easier it is to get a loan for myself.
Here. Okay. Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. First commercial break. In 1936 in Florida was the world's first horse racetrack to make use of what new innovation?
I'm going to guess the mechanical bunny.
No.
Thing that runs around and they chase?
I think that would be more for like greyhound racing. This is horse racing.
Oh.
So this new innovation, photo finish.
You can tell I don't watch a lot of horse races.
No. Photo finish.
Oh,
yes.
okay.
All right. Well, you're 0 for 1, but don't worry. The next one's
I got
hard,
two
and the
more to
next
go.
one, maybe. Okay. All right, Mark, you wanted to tell a little story here.
Well, so we talked last segment about how the mortgage industry is consolidating. We've got banks making fewer mortgages, and we've got a lot of people losing their jobs in the mortgage industry. And of course, I know this to be a fact anecdotally because as broker for Pacific Private Money, one of the Bay Area's leading alternative sources of financing, non-bank real estate loans. I actually have quite a few people calling me who are in or formerly in the mortgage business, looking to see if there's opportunities. Looking to see if we're hiring. A lot of mortgage professionals are looking for ways to stay in the mortgage business, and private mortgage financing is a growing industry right now. But what I really wanted to talk about was my own personal experience in getting a bank loan. So we bought a home and remodeled it extensively. And I will say that I actually was my own client. I used private capital from our client list, who were more than happy to give me a loan at very nice rates that I paid them. In fact, I was paying 9% on average for first, and even borrowed some additional funds from another client at a slightly higher rate for second position. But I used private capital to buy and remodel a home in Novato, and so now we've moved in. The house is done. Everything's been checked off. The city of Novato has given us the occupancy permit. Now I'm out there looking for new conventional financing, and gosh, isn't it fun? Being in the lending business as I am, having pretty good credit and good income, and finding out the the personal reality check. So what I know about bank financing is that when it comes to getting, and when we say bank, we just mean a conventional mortgage. You may get it from your bank. You may go to your either one of the big four banks or maybe your regional bank. But a lot of times, like me, you would go to a trusted, independent mortgage broker who would look around for the best opportunity for you. So I'm looking at getting the best possible loan, and so we've been playing around with this for about 3 weeks, and I'm told I'm about another 3 weeks out from getting this loan. But what's interesting is, it is, as I go through this process, I really do understand why people get frustrated and come to companies like Pacific Private Money, non-bank sources of real estate. No hassle. Yeah, I mean, sure, no one wants to pay our rates, right, between 9 and 10% and a couple of points. But I tell you, it's such a breath of fresh air, and I hear this all the time from borrower clients. They say, the rate's kind of high, but man, was that easy to do, and fast closing. Right now the average conventional mortgage takes 45 days to close. It looks like it's going to take that long for me.
Well, I've been working on an home equity line since September. It's been 6 months.
But I had to do the whole, this was, I had to do the full loan application, go back 2 years on all of my bank statements. I had to go back and show, prior to moving into our home, we were renting temporarily, and I had to go get copies of the rent checks, which didn't exist because I was paying automatically, but that didn't matter. I had to somehow prove that I was actually making those payments on time. It went on and on and on. It took me several days to pull all of the financial information together. But here's what's happening, and Edward, you and I were talking about this before the start of the show. So I have a credit monitoring service, and I happen to use the myfico.com, and I use that one because I know that when I go on there, I'm going to get I think it's owned by Fair Isaac, so you actually get the true FICO, not what the so-called FACO scores.
FACO.
Well, it's funny. People in the credit industry, they call it, there's FICO and there's FACO. What you really want to have is access to your FICO scores. And some of those free credit report services, they give you the FACO score. You got an 800 credit score. It's like, no, you don't. You have one in the high sixes or low sevens.
Wow. How do they?
So
that's a whole other show.
I know. Yeah, it is. Yeah. Well, we should invite a credit professional to talk about that. But a score is not a score. So I know that on myfico.com, when I pull that up, it will actually show me what my true FICO scores are. And anyway, I haven't pulled it up since before I applied for a loan. So it's been, let's say about a month. So I go on it today, I pull it up, and I noticed that there was like a 22-point drop on one of the 3 bureaus. I said, what's that all about? And it says, you applied for new credit, or you obtained new credit. And I'm thinking, wait a minute, I haven't applied for new credit in months, knowing that I was going to go for conventional financing. And the last thing you want to do when you go for conventional financing is get new credit. You're not supposed to make any major purchases. Don't buy a car, don't lease, don't get new credit cards. So I pull up the details, and Experian shows that in March I obtained a credit card from U.S. Bank with a $2,000 limit. But
you didn't.
I did not. So now I'm thinking, well, wait a minute, now what am I going to do? And it asked me, there's a button on there I can actually dispute it. But before I pushed it, the first thing I did was call my mortgage broker, who I had to leave a message for. So I haven't heard back from him yet, to say, hey, I just checked my credit and it says I got new credit, which I know is a no-no whenever you're like, in the middle of getting conventional financing. You want to get denied or conventional financing. The best way to do that is to go out and buy a car or get new credit when you're in the middle of a loan application. If you haven't heard that before, please know that. So anyway, but the reason I called him is because I want to make sure that should I dispute it, because that might open up a whole new can of worms, because it might technically maybe freeze my credit for Experian. It might actually make things worse. So the point is that if this happens with you, first of all, credit monitoring is important. And the only reason I actually didn't know earlier that this had happened, because the monitoring actually, turns out it did alert me, but all those alerts were going into a folder that I don't always read because I get too many emails. So it's like, you get those daily monitoring reports, and after a while, you just don't see them anymore. So I kind of shame on me for not paying attention. But now I know that there's this fraudulent credit application, so now I have to go chase after that. But again, the thing that the point of it was, do I or don't I? And so I called my mortgage professional, and I'm waiting to hear back from him. And I'm guessing he's going to tell me, look, your scores are still fine; they're still in the high 700s. So don't do anything. Don't upset the apple cart. So, but I tell you, it's go ahead.
I was going to say, don't apply for credit. Oh, you didn't.
Yeah,
make sure you don't do it. Don't do it again.
It was interesting that it only showed, though, on one of the bureaus, not all 3.
But I'm surprised that it dropped so much for a silly $2,000 limit.
Isn't that interesting? 22-point drop
that's ridiculous.
For obtaining a new credit card.
I mean, if it was a $200,000 limit, then I'd say, I can see there being that much of a drop.
So, this gets me to thinking about, why companies like Pacific Private Money are thriving now. And we are thriving. The private mortgage industry is on a growth tear right now, where bank mortgages are down and conventional mortgage brokers are thinning out. I mean, there are great conventional mortgage brokers out there, don't get me wrong. The consolidation isn't necessarily all a bad thing in and of themselves, because there are some major mortgage companies, like RPM Mortgage, Rob Spinoza, our co-host. RPM is a fabulous resource for conventional loans, and they've been growing very, very fast. And so there's been a consolidation among that. But I tell you, one of the reasons why Pacific Private Money has been growing is because it's just so much different. We are regulated. Don't get me wrong. This is not like your grandfather's hard money or your father's hard money from 20 years ago, where you could, where essentially as a lender of last resort, if you needed a spare, $20, $50, $100,000, you go to your hard money guy, and which is exactly what it was like 20 years ago. Nowadays, there's still that demand, but that's not the demand that companies like Pacific serve. We don't. We're not. We do get calls from people who call us as a lender of last resort because they're in a pinch, they're in a bind, and they're looking for a way out. But that's not really the type of loans we make. So maybe when we come back from commercial break, we'll talk a little bit more about the differences and why companies like Pacific Private Money are on such a growth tear compared to the conventional mortgage industry, which thanks to Dodd-Frank and TRID and all these new regulations are seeing it much harder nowadays to get conventional low-rate bank financing.
Very good. All right, we're going to get to our second commercial break. Before we do, I also have another mention here for Afterguard's 3-hour San Francisco Bay sailing. They only take 6 passengers aboard at the most. That means their boats are not crowded. You can choose from the Central Basin, Oakland, or Treasure Island Marina, and it'll sail to Treasure Island. Very nice. Weekend daytime sails depart at either 9 a.m. or 1 p.m., and they also have a sunset sail that includes a sparkling beverage and light snacks. Love that. All right. Check them out at Afterguard. Here's the email, info@afterguard.net, or you can go to their website, www.afterguard.net, or call them at 510-535-1954. Okay, second commercial break trivia question. What rather large birds have been trained to tend and move sheep? That's kind of a different one. All right. First caller with correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. What rather large birds have been trained to tend and move sheep? Okay. I'll give you the answer if you don't know that one. Geese.
Oh, I would have guessed ostrich.
Okay. But it is
You need them for eating, for driving, for getting dressed.
Yeah, I was surprised actually. I actually tie my shoes.
Yeah.
Especially if it was my left one like this one.
It's hard to do anything with one hand.
Yeah.
So we'll start the next one by talking about the move.
Yes.
And get into the growth, the types of loans we're doing, and talk about some loans we.
You got an email here for you too.
Yeah, we can do the email maybe after the announcement.
Still trying to figure out what day to have the grand opening.
Well, we're doing the first event on the 27th, so it's not technically like grand opening. It's a fun event for small. Yeah, so that's Wednesday, April 27th. That's that's the evening before the start of the San Francisco CMA, California Mortgage Association, which we're all going to on Thursday and Friday. When I say all, it's probably it's probably me, Rick, maybe Eric. I don't know.
Where is it?
At San Francisco, I think it's the Hyatt.
And that's Thursday and Friday.
Yeah.
Okay. You'll be back in time to do
29th.
Do the show.
Oh shoot. Well, I guess I'll have to. I'll have to look at the schedule and see what I could pop up here and then go back and
The 20. Yeah, because I have here. Okay. Yeah, it was Kevin who called, so we'll call him back.
Okay.
After the show. Here we go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. Here was the second trivia question. What rather large birds have been trained to tend and move sheep?
Well, my first thought was ostrich, but then there's not that many areas in the country, so I'm going to guess geese.
Geese, that is correct. Very good. You sure you weren't a shepherd before in a former life?
maybe in a former life.
Okay. All right. Let's kind of continue on. We got some good stuff to talk about.
Well, and I've got some news also. So we just sent out a little email blast to our client list this past week. We have moved, that is we, Pacific Private Money, have moved into our own building in downtown Novato. Formerly, the Sonoma National Bank building is now the Pacific Private Money building.
There you go.
We've got our own building. It's got a gorgeous lobby. The contractors and the designers did a great job. We've just been getting rave reviews. And
What's the address?
It's 1555 Grant Avenue, 1555 Grant Avenue, downtown Novato. If you've not been to downtown Novato in a while, it is gorgeous. It went through a major redevelopment, the whole downtown, very wide sidewalks. It's extremely clean, no homeless. Gotta love that. And just, it's funny because, we're in northern Marin, and, those of you who live in the Bay Area, and if you know anything about Marin County's got this reputation for being, uber wealthy, frou-frou, she. Well, that's mostly southern Marin, and if you don't know, it's, Tiburon, Mill Valley, Sausalito. In fact, people who live down there don't even consider Novato Marin County.
Yeah.
It's almost like, you're, northern, you might as well be, the southern Petaluma, But those of us who live in Novato love Novato because $1 million still buys you a really nice house. That's one of the best parts about it. The neighborhoods are there's not a lot of traffic, and anyway, the downtown is great, and we're in a little financial district, if I may be so brazen to call it that, because I've got Wells Fargo and B of A across the street, and Chase to my right, and Citibank to my left, and then a number of other regional banks. So there really is a little financial pocket there.
And are you planning a hostile takeover of all of them?
Well, no, but every time I walk across the street to Wells to drop stuff off, they're very, very curious over there. They're always asking me how's business, and in fact, business is really good, and that's the reason why we've moved from a 1,500 square foot office to now a 2,500 square foot wide open office. We've gone from 10 seats to 15 seats, and so we're hiring this coming year. We've got another couple of positions we want to fill, and the reason this is all happening is because our loan volume is growing. We've seen year over year over year over year. The last 5 years we've been growing 10 to 15% year over year in the amount of loans we're originating, and the size of the loans. Our average loan size has been increasing, and the total loans that we originate in any 1 year has been going up, and so we're really excited about that. And our fund has been growing, and we'll talk about the fund a little bit in the fourth segment. But just to compare and contrast the difference between getting a real estate loan, whether you're purchasing or refinancing, from a company like Pacific Private Money or going to your bank. Now, let me just be honest. If you can get a loan from your bank, get a loan from your bank.
In a timely fashion.
Yeah, if it works for you. That's really the key there. If you can get a home equity second, which are not nearly as easy to get as they were 10 years ago, or if you can get the purchase money loan that you need, and you can close it in time and get that great 4% rate, absolutely do that. But the reason people come to Pacific Private Money is because a lot of people are finding it difficult to compete with all cash buyers in this very tight Bay Area residential purchase market. And so we see a lot of clients who come to us frustrated, having spent months and months and months making offers on to purchase property, only to find they've lost out to a cash buyer or someone that had no contingencies. And so if you need 45 days to close using bank financing, well, you're not going to win a lot of contracts. So one of the alternatives that are available to the public are to come to Pacific Private Money for what we call our 11-month bridge loan. It is a special type of loan that's exempt from some of the onerous Dodd-Frank restrictions on lending, meaning we can still make a short-term loan on a residential property, and we can still allow interest-only payments on that, and there's no prepayment penalty to you, so you can pay it back as quickly as you want. But it allows you to capture the property that you want when you want it, and the average terms for a loan on our 11-month purchase money bridge real estate program are 9.9% on the note rate and between 2 and points on the origination side.
And are you finding that those borrowers are, what's the payback period average?
Between 4 and 8 months.
Okay, well,
on
that is
average.
pretty fast.
Very
Yeah.
few of those bridge loans go the full 11 months. And we make it 11 months because there is a regulation that states a loan is considered temporary if it's less than 1 year. So we make it 11 months just so we don't get into trouble with the regulations. That'd be all
Gotcha.
because it turned out to be 12 months and 10 days or something like that. So that's one reason people come to us, and there's actually a few variations of that situation. So we just talked about when you want to actually close quickly, you can use one of our loans, and then a loan from Pacific Private Money, close quickly, and then refinance us conventionally. Another situation is you've got all the equity tied up in your existing home, and you don't want to sell it first, move out, and then go try to buy the next property. So you come to us, we will give you a loan to buy your target property so you don't have to move twice. And we could actually loan you up to 100% of the acquisition price because we're going to cross it with your existing property, which presumably has equity.
Which brings us to an email that we received that
Aha.
specifically addresses that. It says, how come you can accept cross collateral and my bank cannot?
Well, again, banks don't want to do anything outside the box. When you get a bank loan or a conventional mortgage, first of all, you, the borrower, the applicant, you're a collection of ones and zeros. You are a FICO score, you're a W-2 statement, you're 2 years of tax returns, your 11 months of bank statements, your seasoned funds in some account that hasn't been moved around too long. I mean, there's just a number of things they look at. And because the banks are not allowed to be subjective, and they just don't want to see a lot of unusual things. And cross collateralization is just something the banks they're just not set up to do that. It's too complicated. It's outside the box. They just want to make a very simple loan, and quite frankly, they want to sell it. And I'm going to guess, I don't know this for a fact, but I'm going to guess that a loan that has cross collateral, that has additional collateral on that loan, is not something they can package up and sell third party.
That's a very good point. I'm pretty sure that you're right. They can't do that.
So, and we at Pacific Private Money, because again, we're a very subjective lender. That's the biggest difference between a private lender and a bank. A bank, you're a collection of ones and zeros. Everything has to fall within their formula, within a fairly narrow range before you see a green light. Now, when you come to a company like Pacific, we want to hear the story. First, they call with us, okay, so tell me the scenario. What's the story? So if we like the sound of the story, and again, what we like to hear typically are, you only need the money for a short period of time. You have a viable and reliable way of paying us back. We call that the exit strategy. What's your exit strategy? How are you going to pay us back? Because we're not making loans to people in distress who have no idea how they're going to pay us back. But they have collateral. We're not making collateral-based loans that go on and on and on and on and on. In fact, almost no loans in our portfolio are larger than 3 years. In fact, we don't even make that many 2 and 3 year loans. Most of the loans we make are 12-month loans to people who just have a short-term need for the money, and they're going to get conventional financing after that. And so another couple of examples of people who have taken advantage of our 11-month bridge program are, maybe you do have the down payment for your home, and you want to you've got let's say 25, maybe even 30% to put down, and you think, well, I don't have to sell my existing home. I can just go get a second bank loan. So you go for the application, and you come to find out, well, sorry, you don't qualify to have 2 mortgages simultaneously. And a lot of people are really surprised to find that out. And that's because, again, of the new Dodd-Frank restrictions and what's called QM, qualified mortgage rule, that limits what conventional lenders can lend based on your debt-to-income ratios. And there's this arbitrary number of 43. If it's over 43%, you're going to get turned down. If your debt-to-income ratio, that is over 43%, they're going to say, sorry. And so that surprises a lot of people, where before 10 years ago, you could have just gone to the bank with your good FICO score and gotten another loan. So we do see some of those. And again, it's just it's an easy way. So if you're a real estate professional out there, a mortgage broker or a realtor, this is a kind of a tool that you should be aware of, and somehow or other try to keep the company top of mind. Give us a call. We'll send you more information. If you're a consumer out there and you are also thinking of a way to either buy up or buy down in this real estate market and you didn't realize there was this financing option available to you, yes, it's not cheap, but it gets you the house you want. It gets the deal done. So we're a plan B when plan A fails. Give us a look. The best way to contact us is just go to our website, pacificprivatemoney.com, pacificprivatemoney.com.
Great. We're going to cut to our last commercial break here. Before we do, we want to make one last mention for our friends at Pacific Trade Exchange.
Gotta love those companies whose names begin with Pacific.
Exactly. They're business-to-business barter. You can buy goods using barter instead of cash. PacificTradeExchange.com. And when we come back, we're going to teach the audience how they can earn. How much is the fund paying right now?
8%, a little over 8%.
A little over 8%.
Yeah.
Okay. All right. So here's our third trivia question. An Israeli researcher discovered the milk of a certain animal has 3 times the level of vitamin C of cow's milk and can also combat diarrhea and dehydration. Which animal? All right. The first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing. What do you think?
Oh, I'll shout it out.
Shout it out. Okay.
Thank you.
Minutes, 24 seconds.
Oh, good.
Stupid Walgreens were supposed to call me about 4 hours ago.
Nice.
Telling me my Vicodin was ready. Just want to make sure I can sleep tonight.
Oh, absolutely.
After I got this done 2 days later, I was doing pull-ups.
Mm-hmm.
This one, who knows?
You can do pull-ups. I can do one.
Oh, you can do more than that.
Oh, yeah.
I
I watch the young guys go in there.
Yeah. Well, it's practice.
I'm going to do deadlifts
I hate that.
tonight. He already warned me on Tuesday.
Warned
I'm
you?
gonna do Hungarian or Yugoslavian or I don't know what kind of deadlifts. It's funny they always have these fancy names for stuff.
I mean, it's not typical like that.
Maybe, yeah. Well, it's a certain type of deadlift. Yeah.
Oh. I like the kind you stand in the machine thing. Those are good because that way you don't hurt your back. It's not a machine.
Well, he's pretty good with form. He makes sure I don't hurt myself. Although sometimes I strain my lower back a little bit if we go too heavy.
Especially with deadlifts, be careful.
Yeah, I know.
All right, here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn. Third trivia question. An Israeli researcher discovered the milk of a certain animal has 3 times the level of vitamin C than cow's milk and also can combat diarrhea and dehydration.
Aardvark.
That's aardvark. Come on. Think Israeli, think Middle East.
I don't know, marmot.
A marmot. Come on. You're killing me, Smalls.
You can milk cats, can't you? I saw that movie on the Fockers.
That was funny. I remember a camel. A camel, yeah. That's what I figured Israeli and all that stuff. Okay, so Mark, we teased the audience before we went to break about earning 8% or more than potentially more than 8%. Well, how can they do that?
Well, this wouldn't be an episode of The Best of Investing if we didn't talk again about one of Edward's and my favorite investment strategies. And it's a mortgage investing strategy, investing in what we call the Pacific Money Fund. And the Pacific Money Fund is a mortgage pool fund. And a mortgage pool fund is where many people contribute their money to a fund, much like, and it operates much like a mutual fund.
Yeah.
And in fact, we operate it both on the accounting side and on the legal side strategy, much like a mutual fund. The fund is used to make loans, and so the only assets in the fund are loans and cash. And so we make real estate loans, mostly short term, and these loans tend to revolve. In fact, we've made, I think, nearly 120 loans in the fund since its inception 3 years ago, and more than half of them have paid back. About 60 of them have paid back. Our current portfolio is about 60 loans right now in the fund. So it's about half. About half the loans we've made have paid back, and the ones that haven't paid back have all been made, most of them in the last year. So it's a fairly quick revolving tool, and which again is good news, because if you're concerned about the real estate cycle, the next cycle, then you should be. We all are. We're I'm in the lending business. I lend on real estate. I need to know what's happening in real estate. Even though we make conservative loan-to-value loans of about 70% to the maximum, we want to know when the next cycle is likely to hit. And so because real estate doesn't move quickly, don't forget, when the market quote-unquote crashed last time, it actually started to go down in 2007, but it didn't hit the bottom until 2010. So it was a good between 2 and 3 years that we were watching values go down. And so since we're not generally making those types of loans, we're generally making short-term loans to people who've got a strategy to pay us back, and we're usually making those at 70% loan-to-value or less. So we believe our fund has safety and security features that that set it apart from other types of funds. So the Pacific Money Fund, we've talked about it, that's like a mutual fund of mortgage-backed notes. The average loan that we make is between 9 and 10%, and we also throw in half of the origination fees. So after expenses, our fund has been paying out solidly between 8 and 8.2% on an annualized basis. We make monthly distributions, and how that works is we take the income from the fund every month. We price our shares at $1,000 per share, and the fund earns money during the month from interest income and origination fee income, and whatever that share price grows to, we distribute that back down to $1,000. Now, what's neat about the fund is you could be one of two types of investors. You could be an income investor, or you can be a growth investor. An income investor takes those distributions from us in cash. We usually electronic transfer it to your account, maybe your IRA account if you're investing through your IRA, or your checking account, or your savings account. But if you're a growth investor, maybe you're investing through your IRA and you don't want distributions, you can have your distributions actually buy fractional shares. So that's another way you can do that. So, we've been in operation since 2013. Very, very popular product right now. I would say mortgage investing has become more popular over the last several years, much to the chagrin of those people who've been investing in mortgages for decades. And we do work with some pretty seasoned note investors that are a little bit frustrated that they can't, that lots and lots and lots of people are now getting into mortgage investing. And why are they doing that? Well, what happened this week in the stock market again, Edward? I mean, just see what was happening. It was
went down a little bit.
it went up and then it went down. Then it went up and then it went down. Then it was just a seesaw. Basically no gain for 2016. We're basically dead even, and just not a lot of long-term prospects for growth. Now, would you want to put all your eggs in one basket and throw everything into mortgage-backed investments? Of course not. What we're talking about is a strategy where you can basically supercharge the yield you earn on your overall portfolio. And what we're talking about is essentially, it's called alternative financing, or I'm sorry, not alternative financing. Pacific Private Money Loans is alternative financing options, but our fund is an alternative investment. It's alternative because it's not considered a liquid investment. You can't sell it like stocks, but it's still not that illiquid. I mean, we have redemptions on a fairly regular basis, and we're able to usually redeem those shares within weeks.
Okay. Also, you said that a lot of the loans, 70% loan to value is what your max, but that's not what the average loan to value in the fund is, though.
Right. We track the weighted average loan to value in our fund because it's an important number to monitor. And right now we're at 54% weighted average loan to value. So we believe that portfolio of loans in our fund is well secured. We think it's positioned for the market topping out, maybe in terms of and again I don't like to use the word safe or secure because those are kind of no-nos in investing. What I like to say is we have safety and security features that I think make the Pacific Money Fund stand out among other investment strategies that have been tried and true for many, many years.
And you can probably use the word conservative because the 54% loan to value sure seems pretty conservative.
Well, I mean, again, for more information, you really need to call and talk to one of the professionals at Pacific Private Money and get more information on it. The average investor in the fund has studied the program actually for some time. We had an investor come in last month who contacted us a year ago. And they got on our list, their distribution list, were watching our monthly newsletter. They were seeing the monthly distributions. They were seeing the pictures of some of the properties that we put usually on page 3 of the monthly manager report that I write every month for our members and for those people kind of in our list of interested parties. And so take your time. We don't push this on anyone. We're not going to ask you, so when can we expect your $50,000 check, Mr. Smith? That's not how we promote. We're more of the attraction rather than overt promotion. Now, of course, we're talking about it on the radio show, and this is something we obviously want to get the word out to people that there's this option out there where you can earn 8% or more on your money
with no load.
With no load going in or out. All that means we don't take part of your investment. If you invest $50,000 or more, our average investor actually right now we're close to $200,000 is the average investment size.
There's any commission.
Right, there's no commission. So if you put $100,000 into the Pacific Money Fund, all of that money goes to work for you, and when you ask for your money back, you get all of it back. And so if you keep it for 2 years.
Yeah, I was going to say, have you had many people redeem within the 2-year period?
Only 3 to date.
3 to date?
Yeah,
Okay.
yeah. So we've got close to 100 investors in there now, and so we just.
And there's a small penalty if they do.
There's a small penalty if you redeem sooner than 2 years. It's not a huge penalty, but it's an incentive to keep your money in.
Give out your information one more time so people can get a hold of you.
So PacificPrivateMoney.com 415-883-2150. Contact us for information about short-term financing or how you can earn 8% or more, and we'll send you some information that or meet with you at our new shiny offices. Come see us in downtown Amano.
Very good. Thoughts for the day. There are 2 ways of spreading light: to be a candle or be the mirror that reflects it. I like that. And Edith Wharton said that. I don't know if that's from Wharton College, but and Milton Berle said, and if opportunity doesn't knock, build a door. I like that one. Tune in next week to The Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
Excellent.
So when with those people who did read